Hello, everyone. Thanks for tuning in. Welcome to our session. We're doing welcome to our session on how to pitch an AI company. The only reason we understand how to do this, or the proof of us knowing how to pitch a company is that over the past few years, over $600 million have been raised with decks that we touched on. But there's a big but to that story, which is that fundraising has always been kind of weird. It's always been kind of weird. I remember when we started Slidebean. I remember this company raised funding, and I thought it was crazy. It was this company called Yo. They made fun of this in that Silicon Valley series. It was this company called Yo that all you could do in Yo was just send messages, send Yos, not even like a message, just Yo back and forth between the app. And that's it. There was no communication. And I remember seeing this and saying, well, this is idiotic first, but second, like, why would this company raise money and not us? Right? Like that's a it didn't make any sense, right? And then, if you fast forward a few years to today, right, you come across stuff like this. You come across SpaceX's $800 billion valuation, or Ilya, one of the co-founders of OpenAI, raising $1 billion just as a seed or pre-seed round for his company. And does that make any sense, right? It's all very confusing. So that's the first thing I wanna talk about today. I want to talk about what the fuck is going on with funding, because I think that if you want to raise funding for an AI company today, you sort of have to understand a little bit of the fundraising context. So I have some thoughts on this, and then I have some thoughts on a pitch deck. We're gonna get into the actual pitching part. I've gotten much better at multitasking, so I see you guys on the Zoom. Some of you guys are on the Zoom link. Welcome, thanks for tuning in to Zoom. I see you guys here, and then I see you guys on the YouTube live stream. You guys have like a 20-30 second delay, but I can reach you guys here. And whenever you come up with questions, stuff, just throw it in there. I'll try to keep up. I'll have a couple breaks for questions, and that way we'll prove that this is live. Sometimes people ask, "Oh, is this live, or is this just some recording?" It's live. I'm here. Okay, let's do it. So what the hell is going on with fundraising? Let's understand a few basics first. These are some actual real data points. This is from a HubSpot report. So this is the amount of capital invested in startups, or in tech companies over the last few years. There's some waviness to that, as you can see, but overall the trend, and this is an early 2025 report, but as we close 2025, that trend sort of continued in the sense that a lot more money was raised in 2025. There's more money going to companies, which is great for us. Yes, no. Well, there's this other chart that sort of overlaps that one, which is the amount of the amount of startup deals that happened in 2025. And you can see that line sort of follows the inverse, right? There's what that's basically saying is, well, there is more money going to startups, but fewer companies are able to capture that money. So we're basically seeing some capital concentration, more money going to fewer companies. So which are the startups that can get funded, right? In the end, if you guys can raise money, then you're on your way. But the question is, how do you become one of those now fewer companies, or fewer percentage of companies that are managing to raise any capital? So let's dig a little deeper into some of those numbers. So this is another report. This comes from PitchBook. This is the median deal size across venture capital. There's some really crazy stuff happening here, because you can see that the median. By the way, this chart is like really confusing. This is the 2024 number. I don't know if you can see my cursor, and then this is the 2025 number, and the line is not straight for some reason. I don't know, but I've dug deeper into the report where this came from, and yeah, so this is kind of the number. So we're seeing $900,000 as a standard pre-seed round in 2025, and we're seeing $3.6 million as a standard seed round in 2025. If you want to convert that into valuations, that's a valuation. Those are valuations of $8 million ish for pre-seed and $15 million ish for seed. I translated that into this if you want to take a better screenshot of it. By the way, for you guys on Zoom, like a bunch of people, almost 100 people on Zoom, which is crazy. Thanks. I always get the question, is this being recorded? Well, it's being live streamed to our Startup Club channel. So if you ever if you want to rewatch, then that's where you can go. Okay. So I mean, what's madness to me, right, is that these are very, very big. This is a lot of money at a very, very high valuation for startups. Um, that sometimes comes with problems, which I'll get to. But overall, the conclusion of this new data is that these seed rounds, a seed round of $3.6 million. I always say back in my day, but at least back when we were fundraising for Slidebean, like $3.6 million, that would have been a Series A round, right? So how do we go from a seed being something like 1 million to being 3.6 million? That's kind of this trend that we're seeing, right? Fewer companies capturing more capital. And why is that, right? So why are they raising more, or why are investors pouring more money into these businesses? Well, part of it is this, right? Part of it is that the time between rounds has gotten longer. Again, back in my day, yeah, I mean, it's not even in the chart. Back when we were fundraising, the general rule or recommendation is like, hey, you should raise money for something like 18 months of runway. That means that, at month 12, you've probably hit the milestone that you were looking for. You start fundraising and you have 6 months of cushion in order to close that round. That has been very visibly extended, right? So at least in the first half of 25, the average and the median time between rounds is much more closer to 24, sometimes even above 24, which means that companies are raising money to last longer, right? They're raising money. I mean, this extra money that they're raising lasts longer. The idea is that you have to, you have more time because there's more capital out there, because you need more traction. Yes, but I think both of those are valid reasons. Companies are kind of being able to secure capital, not just for 18 months, but for 24 months. And I think that's important because it connects very directly to this topic. So this is a little chart that we made for our last video. My team can post a link to the Zoom people for you guys on the YouTube stream. It's literally the last video that we put on the channel. It talks a little bit about these cycles in fundraising, right? And I think that this is very real. I don't want to go all the way back, that far back, but let's say 2014, for example. This was a fantastic time to raise money. This peak seed funding, a lot of money. There were a lot of ideas. There were a lot of founders. There was some money that's some rebounding from 2018. So a lot of money. There was money going to a lot of companies. A lot of companies raised money in 2024. And then what happened in 2026 was, well, not all of these companies managed to get to Series A, right? There were too many companies, too many ideas happening. This was sort of like a spring of startups. So if you had an idea in 2024, there's a good chance you were raising money for it. But not all ideas are great. Not all ideas managed to to get to the next phase. And so you end up in this Series A crunch, right? Where fewer companies raised money. Now, 2017, 2019, we had some SoftBank effect. So the SoftBank effect of that is, WeWork is kind of included there. SoftBank being this fund, injecting billions of dollars into companies getting valued at tens of billions of dollars, like these $40 million unicorns were happening. So like that got people excited again, right? So through 2017, 2019, people are excited about investing in startups because there's that visibility over that payback, over that payoff a few months or a few years in advance. And I think that concluded with sort of COVID mania, which is what I call it. COVID mania is this time post-COVID where all these stimulus checks, the stock market booming, we had all this money flowing, and not a lot of places to go. Interest rates were low, so where if you have a lot of money, where do you put it? You put it in startups, right? You're willing to risk it. And then that came along with a reset, right? So we've seen at least two of these waves, or I've seen at least two of these waves in my startup founder lifetime. And now, like today, 24, 25, 26, we're living sort of through this rebound after this COVID reset. This is, we could call it the AI boom. And I think that's very real, right? A lot of companies are raising money because everybody is very excited about AI. There's you can call it a bubble. I mean, you might or might not want to call it a bubble, but there's a lot of money flowing into these companies. And for us founders who are building companies in the space, that's overall good news. We need to remember that there's a good chance that these cycles will repeat themselves. So how do we prepare for the next phase? Like as I said before, like these are the graduation rates from seed to Series A. So the amount of companies that raised money in seed and also then went on to raise a Series A. Notice that that number dropped as low as 6% in 2022. Again, this we were coming down from that wave of series of the COVID crunch. That started increasing in 2023 as these, as these companies, the better companies that raise seed, fewer companies raise seed. So, there's a higher chance of those companies raising another round. I don't have, the source of this data didn't have any numbers for it last year, but another company, which again is not the same source, so it might be mixed, clocked that graduation rate from C to Series A at 15%. So like it kind of looks to be going down again, but it's not apples to apples because it's different sources. But anyway, maybe the conclusion from that is we are in an upcycle, right? So we're raising money for this upcycle, but we have to remember that there is a chance that we'll be in a down cycle and in X amount of months or years. And we need to make sure that we either raise enough money to survive that crunch or I think get enough traction to survive that crunch so that you are one of those select Series A companies that are able to raise the next round. I think that that's very important. If we wanted to summarize this even more into something you can screenshot, something you can take, it's this, right? So more founders are competing for fewer but larger checks. That's what's happening. And this extra money that companies are raising, they're raising it to be safe, right? We're raising it because we don't know, because we're uncertain about the fundraising landscape for startups in a few months or years, and we want to make sure that we are ready, right? Ready to tackle on that. So that's a quick, what was that, like a 10-minute summary of the current fundraising landscape. Maybe a good chance for a small break for questions, if any have come up. I don't see any. So I'll go once and twice and thrice. Bram says this was very clear. Thank you. I'm glad. Good. Okay, so I'll keep going. Throw questions. If they're easy, I'll bring them. I'll answer them. Otherwise, we'll save them for the end. Okay, let's keep going. So I think that the next thing that I think we ought to talk about is what is an AI company? What is an AI company today? And I always like to go back to the 90s. I have no idea what a tech startup was in the 90s. I was 10, but if you remember or if you've read, in the 90s, an e-commerce startup would have absolutely been a tech company, right? So we had, we're part of it was part of the dot-com bubble, of course, but you'd have Amazon, you'd have Boo.com, and all these companies that were essentially e-commerce platforms, right? These e-commerce platforms, they would go on and raise millions of dollars, get crazy valuations, go public sometimes. Why? Well, because in order to build everybody's excited about the internet, yes, but in order to build these companies, in order to start these businesses, you need a lot of money, right? Like back then, you couldn't get away with going to Shopify and starting your e-commerce. You had to buy some servers and install them somewhere and configure them. So you needed somebody who could install and maintain the servers, and then somebody who could code the platform. And web was, and the internet was very new, and you were kind of building shit from scratch a lot. By the way, I see a question on these trends being, if these trends are only US or if they extend. I think that US being one of the largest, if not the largest startup hub, I think it sets the trends. Sometimes there's a little bit of a delay of how that trend behaves in the rest of the world, but overall, it's very worldwide, more worldwide now. But anyway, so this e-commerce startup, this was a venture backable company. In the 90s, if you run an e-commerce, you can raise venture capital for it. But what happened? What happened over the last 20 years? Well, an e-commerce company kind of became like a normal company, right? Like in this day and age, you don't need to be you don't, if you're an e-commerce company, sorry, do you raise venture capital? I don't think you do, honestly. I don't think you do. Why? Because you can start this business on Shopify. You need a lot of capital to do that, if any capital at all, right? So if you're just a reseller, a marketplace, an e-commerce thing you build somewhere, the expectation, as investors see it is well, prove to me that you're doing something. And then an e-commerce company might raise money later, but they would raise money only if they have some really core innovation or after they get traction, right? So we've kind of shifted this thing that used to be like a really edgy bubble, dot-com bubble, right? Like tech, like pure tech company that has shifted into what we call now a normal company. And I like that analogy to echo it into what we call an AI company today, right? Because for the longest time, I think that, you know, up to 1 or 2 years ago, if you were building an AI company, you sort of classified in this category, I like to call like R&D startup, right? So what's an R&D startup? It's a startup that's made up of PhDs and really advanced scientists and engineers who are kind of like writing papers, like literally publishing papers, not too different from the way OpenAI started, right? So like this is a company that raised money, that got lucky, raised some money, including from Elon and some other people who donated this money to this nonprofit. But then the idea is like, well, this nonprofit is going to need tens of millions, if not hundreds of millions of dollars before it can come up with anything. And maybe it won't come up with anything at all, right? But that's kind of like the bet with R&D. And you see that with, you know, biotech companies, hardware companies sort of operate in that world where the expectation is you will need many years of R&D and many bright minds together working without the expectation of revenue for a long time, right? Because we're building some really big future promise thing. But now, well, there's another type of AI company, and that AI company is what I would call a normal startup, right? To me, a normal startup is something like a SaaS, right? Like a software as a service. Why is that a normal startup? Because a normal startup, you know, goes and hosts in AWS. They don't need to buy servers anymore. They can code and build a product in a few months, right? And or an app, and they launch it. The expectation is that you'll get revenue, you know, within a few months, or you know, traction customers within months, if not a year, right? So they expect, you know, the building software is expensive, yes, but the idea is that you can build it a lot faster because we have all these tools now, um, libraries and again APIs and, you know, stuff that, you know, you no longer need to build from scratch. So we've productized a little bit that building process. And now now there's a world where that company just uses OpenAI's API or uses some other LLM connected to their system to make the product better. And does that make that company an AI company? Yes. I mean, by name, you could call it an AI company, but it's just very different from the other one, right? So we sort of have to make this very, very big differentiation as to like, there are AI companies and there are AI companies. The right-hand side, the R&D startup company, that's Ilya's company, the former OpenAI founder, raises $1 billion. Why? Because it's going to need years of R&D to build something that can be sold, and people are willing to take that bet. And obviously founder with a lot of credibility, et cetera. The rest of us, right? The rest of us are the other are the other type of AI company, right? If we're not PhDs or anything of the sort, and we're building a product, a SaaS for B2B or B2C or an app, whatever, you know, most tech startups, I think that there's very much still venture capital for that type of company. But just like with e-commerce, we're kind of seeing that shift moving to the left where that company it's easier to build that company. I think that if it's a controversial line, but you know, if vibe coding actually ends up working, you know, you can vibe code an app. I mean, maybe not today. Maybe you still need an engineer to iron out all the quirks. But you know, fast forward 3, 4 years, maybe you'll be able to build an app by vibe coding. You don't need an engineer. You need a lot of time, and we maybe productize maybe AI companies or, you know, or typical tech companies apps, you know, become as standardized as e-commerce became, right? Because now we have the tools to build them and we don't need to raise a lot of money to get off the ground. That, I don't know, but maybe we'll see. That's not what today's about. The point is we have to understand if we're one or the other, right? These are not the same type of company. You could call both of these companies AI company, but they're very different. The investors that invest in them are very different, and the expectation of traction for each one of them is very different. The right type company, again, that's the Ilya $1 billion round company. That company can get away with not having a lot of traction. I would bet $1 that most of you guys in both of the streams are the left type of company. And if for you, or for us, I guess, you know, traction is everything. Traction is everything. Why? Because it's gonna get easier and easier to build a company of the left type of AI company. It's easier, right? We have vibe coding again. We have tools and libraries, and we can bring AI into these products without having to build our own LLMs, right? We can just plug into APIs and just have AI that works for whatever product and application we have, right? So if you are the left type of company, how do you stand apart from the others? It's traction. It really is, right? I think that what we're seeing now in the ecosystem is it's so easy to start a business. It's ever easier to start a business. It's ever easier to do it without that much money, which means that the only way you stand out, either for this round or for the next round or for future rounds, even that crunch right between seed and Series A, it's like the companies that are winning are the ones that can prove that their product works. That's it. That's it. You have to prove that the product works, and proving that the product works is easier on the coding side, harder, I think, on the marketing and growth side, because I think the marketing ecosystem has changed to a point where it's not easy to pay ads anymore. People have become more ad blind, and there are ad blockers. And if you're a premium product, chances are people, if you're selling to a certain level of user, there's a good chance that they pay for you to premium, right? So you can't advertise on them there to them there. So I think customer acquisition has gotten more expensive. That's a topic for another day. But for you guys as founders, like that's why traction becomes so crucial. Okay, so let's talk a little bit about pitching. Let's talk a little bit about pitching your startup. I mentioned that with Slidebean, about $600 million have been raised on decks that we've helped craft. Most of the time, that's been either with our platform, which I'll mention later, but it's either designing decks or writing decks. And when we work with a company to write a deck, to write a pitch deck, what founders, what we would love to do is to capture the story, right? And talk to a founder and just capture what they're talking about. Just like, give me a summary of what you have, business plan, whatever. Doesn't need to be a written business plan, but we'll write it and we'll put it in great form on a pitch deck. But what happens is that most of the founders we end up talking to that come to us because they need a pitch deck, they're really struggling with these 5 items. So that's the 5 items that I wanted to talk about today, or that I'm going to focus on the most. TAM, go-to-market, financials, valuation, and capital needed. Most of the time that again, most of the founders I will talk to, again, when we're discussing working on a pitch deck, they think they have this sorted out and they don't. And that's why I'm, going one step ahead and telling you how to sort this stuff. Okay. So, on the pitch deck, I think people, sometimes get tripped a little bit with pitch decks because they're trying to turn a pitch deck into a business plan. I think that in a nutshell, right, you come up with a business plan. No, I mean, let's go back to the 90s again. In the 90s, you would come up with this business. So what do? Well, you write a business plan. And the business plan is like this 40-page document, no AI. So you have to write 40 pages worth of plans, structure it, format it in Word and whatever, print it and give it to people. The problem with that is that businesses change so quickly. Startups move so quickly that business plans get outdated like in weeks, right? I had to write a business plan for my visa, I remember, and it took me the damn thing took me like a month and a half to write. And by the time I was done, like everything had changed, and I'm like, I just send it like that. But everything changes so quickly, and when you're dealing with a 40-page document, like it's just too much, right? So I think that very naturally, and I'm happy about this, like we've evolved from business plans into saying, well, the founder, and at least in tech startups, the founder has a business plan in their head. That business plan is ever changing. This pitch deck is a quick summary of what that business plan is today, and obviously it's about to change, right? But it is in the end a story. It's a story about numbers. It's a story about the product and the technology. And it's a story about the founders and the people, right? So if I were to kind of write that into a single sentence, to me, it looks something like this. A pitch deck is a company story. It's a story of what the company has accomplished and the vision for what it can become. That sounds nice in the abstract. I think it is. It's the core of what a pitch deck is. But I think people often forget this one part, which is, well, how are you going to get there, right? How are you going to get to traction to that? I always say that ideas are worthless without execution. So the pitch deck should not just be about an idea. It should just be about execution. And I think that that's one of the big caveats, right? Where it's like, hey, I have this idea, I have this product. I've I can visualize us building this product and launching it, and that's it. That's as far as the founder could see. When in reality, the you have to kind of be able to visualize or be able to at least sell your plans as to what's going to happen after that. Um, I again, sometimes you don't have that visualization, and so that begs the question, well, are you actually ready to raise money if you haven't done that homework, if you haven't sort of like made the plans as to where the business is going? And when people, and I used to ask this question in another webinar. It's like, are you ready to raise money? Yes, we're raising money. Yeah, we're ready. We have everything, right? But there's one question, right? There's one big caveat with fundraising that I think trips a lot of people, and I wanted to kind of make a little parenthesis to talk about. If you were in our session last week, maybe you've seen these slides. Sorry, but I think they're important for everyone, regardless. So I'm gonna go quickly through these. Let's imagine that you're ready to raise money. You guys, you're ready to raise money. You heard me say that the average pre-seed round was 900,000, so you're maybe rounding that up to 1 million, and so you're raising $1 million. And the way you're thinking about this is, oh, we're gonna give these investors 15% of the company in exchange for that $1 million. It's normal, right? In startups, that doesn't look too crazy. So investors get 15%. Great. So what becomes of your company, right? And that's where I was talking about. So like visualizing where the company goes. Well, let's say that you're assuming you run some forecasts and you assume that this company grows to maybe something like $10 million in annual revenue, at which point you become profitable and you start making money. Great. You don't need to raise money again. A lot of founders pitch their companies like that. So great. You're raising $1 million. You're making 10 million. How much of that turns into profit? Well, a typical EBITDA, right? Earnings before taxes, is going to be about 10%. If you take taxes, that's 20%. So you maybe end up with 8% of profit, of pure net profit, after taxes. 800,000, which is a shit ton of money by every measure. So now you go to your investors and to your board and to your team and you say, okay, well, now we're going to share dividends of this growth. Well, 15% of that goes to investors because they own 15% of the company, which means they get $120,000, 15% of the 800,000. Well, that means that it's going to take them 9 years to get their $1 million investment back. And that's not even taking into account ROI, like actually making profit over their investment. So many of the companies that I talk to that tell me, hey, we're ready to raise money, we're just looking for this investor, they have this idea in their heads of, hey, it's a $1 million round for 15% of the company, and we're going to get this company to 10 million. And that's not an exciting investment. And it's a classic error I see. I can talk a little bit more about this, but let me move to another scenario, right? The company that maybe is more ready, or maybe some other stuff that you have to be ready about. Another same idea, right? So this company two is raising another million, is also raising $1 million. They get 15% for investors, but this company is not going to focus on profits. They're just going to focus on growing more and more very fast, which means that they're not going to be profitable, which means that they're going to need more money. That means that new investors will come in. The share that the first investors got is going to get diluted, right? It's going to go from maybe 15 to 10, right? It keeps shrinking because more investors join the company. But because the company is not focused on profits, it's just focused on growing really fast. Maybe it hits $50 million in revenue. It's not profitable. It still loses money, but it makes $50 million in revenue. The difference between company one and company two is that for company two, there's a good chance a bigger company will want to buy this company out. And because it's growing, because it has that much revenue, because it has that many customers, or some really good technology that they built because they were burning money, or because they have a lot of customers that are interesting to the larger company, that company may be acquired, and it may be sold for something like 5 times revenue, which is not a crazy valuation for an exit. And so what happens to this investor? Well, these guys have 10%. That means they get a payback of 25 million, which means that they've 25x'd their money in the span of 7 years. Like that is the game of venture capital. And again, if you're not ready to either to sell your company or to operate at this very, very risky approach of just burning money every month because your focus is growth, then you're maybe a different type of company, right? Because you need to be growing super fast. It's probably not necessarily, but probably not going to be a profitable business. You're probably going to need many rounds of investment, and then the only way you can get this, you can get a payback on that, is through an exit. So, if we were to add a little note to our requirements for a pitch deck, it's that, well, a pitch deck is a company story, of what it has accomplished, what it can become, but in there we have to answer, well, how are we going to get there? How are we going to execute on this? And, well, in the end, how much money are you going to make me, the investor? Okay, so the next thing I have is some breakdown of slides, like actual slides, with some good examples of how to structure a pitch deck. Before I do that, since I don't no longer have any more, since I'm done with kind of like the context of fundraising, maybe let's do another round of questions. Maybe I see your role. Through the ride of growing revenue as the key metric and making no profits was no longer attractive for thought the ride of growing revenue as the key metric and making no profits was no longer attractive for investors. Is that correct? Are VCs still not looking at profit and or free cash flow? That's a great question. I think this relates a lot to the cycles we were talking about. If you read a blog post or a news article saying, oh, like founders now care about profits, check the date. Check the date, because there's a good chance that was written in 23, where that was very real, right? 23, 24. Now, today, I don't think that's the case. I think that we are very much in this AI race where profits are less important than growth today, I think. Right. It's just showing, like, right now, there's a lot of capital flowing. That's not a problem. Companies are not running out of money. There's no danger of companies running out of money because of lack of capital in the market. That's not where we are now. Capital is there, money is there. Money is going to these AI companies. The concern, the fear today is, well, which one's going to stand out from this massive crowd of AI companies? Because that's what we have, right? We have a new AI product look at Product Hunt. Like, there's a new AI thing for everything, right? So which ones win? I think that's the race today, much more than which one is profitable. And again, that shifts a lot with these fundraising cycles I mentioned. I see one more. How did the coordinated or parallel strategies moves by NVIDIA, Microsoft, Anthropic reshape expectations around infrastructure control, and what implications does that have for venture-backed AI startups? Wow, this is it's a mouthful of a question. I think that, at least for tech, I think that, at least for companies that are building products, I believe, or at least as I've seen, infrastructure has not been a huge part of the conversation, right? Like, if you're using, I don't know, Gemini's API, or you're using Google, Gemini or OpenAI's API in your product, then you don't really have to worry about the infrastructure. That's Google's problem. We have to assume maybe that these guys are running these data centers at a loss, which means that our API costs for AI might get higher, right? Right now, like, it's a butchery competition for the lower price, and maybe those prices will increase. But beyond that, I don't feel like the infrastructure mess is something that affects companies that are just solely focused on building software. If you're building your own LLM, then that's another question. That's another conversation entirely. As fewer companies are raising larger rounds, any idea what proportion of that capital is flowing to AI-driven businesses compared to the broader market? That's a good question. Again, two thoughts on that. First, like, is any business not an AI business these days, right? Like, it's almost like a given that you will integrate some form of AI, because it's just like AWS, right? AI is like AWS now. So that's one. I have seen, I've seen some reports, even in the last few months, on, valuations for companies that are, more AI driven being higher, right? Like, there's this multiplier of valuation that you get because you're an AI company. But I think that yeah, and that's a fact. That's the fact. That's the data. What data says. In my opinion, like, I think that that line's going to be very blurry soon enough because everything sort of integrates with AI now. I see your question here on the Zoom, I'm sorry, on the YouTube live stream. I'm working on a patent that will cool data centers hybrid, potentially saving 20-30%. Won't use water, less energy. Um, Questions. I don't have a team. Will it be better just to license or try to put a team together? That's up to you, right? I think those are two very different approaches. I mean, if you have a patent for something, um, a patent's very expensive. Let's start there. It's probably tens of thousands of dollars to get a patent through, not just provisional, but get a patent through. I guess, that question is more like, what do you want to do, right, with a patent? Do you want to build a company around it, which comes with its own set of risks and pain, but also benefits? Or, do you want to find somebody that licenses this patent, which is honestly a process I know very little about. I don't know how you knock on a door and try to sell a patent on something. I generally don't. So sorry. Okay. I'll take the last one and then I'll move to the slides. While writing a pitch deck, you're not yet in operation, but you need funding because of the cost of the actual data or simulated data in the AI product. Should you still fix a particular pricing to the product while calculating TAM sum? Good question. I think it's a good segue into the slide section. Okay. So let's talk about slides. Right. So these are, again, let's remember, these are the big questions that we have to answer, but this is still, I think, a little bit abstract. So I've broken that even further for you guys. I've broken it down all the way to the simplest 4 questions that a deck needs to answer. So let's look at those 4 questions. And then they're like tied to sections. I couldn't have made it easier. Okay. So what should the deck do to answer the stuff that we're talking about? First, it should talk about what opportunity have you discovered in the market? What's missing? Is there a pain point that some certain group of people are experiencing that doesn't have a solution? 2, what have you built to tackle this problem, right? How does it work? Who is it for, right? Who buys this product? It's usually not everybody. How much are you growing and how much are you going to continue to grow? Tying back to traction. I think that there's always a chance for traction. If you're a seed company, right, and we have another webinar that talks a little bit about this. By the way, we're doing these sessions every week now. Every week for February and March, we're going to do one live session on Thursdays around the same time. So if you haven't seen them, make sure to check them out. My team might paste the link to our startup events page, where you'll get it. And 2, or you can just go to subscribe to the YouTube channel where we'll live stream them anyway. So that way you'll have it. Okay. So how much are you growing? How much are you going to grow? Traction, right? So we're talking about traction in the sense that even at the earliest stage, you can get traction because traction might be a landing page that tests how much conversion you get on this product. Traction might be a wait list. Traction, if you're B2B, traction might be letters of intent or conversations with companies. So, to your question about pricing, it's like, you can imagine what the pricing is, but the only real way to know what the pricing can be is by talking to a potential customer. Now, do you need a finished product to talk to a potential customer? I don't think so. I think you can just literally get out of the building and talk to potential customers. So a lot of those questions, traction, right? A lot of that validation doesn't require a finished product and tens of thousands of dollars or months of work to finish it, right? So traction doesn't need a product, is what I'm trying to say. And then the other step is like, well, why are you and your team the right team to change the status quo? Those are the 4 core questions. I always like this metaphor of like zooming out. Whenever you're working on your pitch deck, we sometimes get caught up in a slide, right? We're caught up in the slide being overcrowded or well designed, or whether we use this photo or this photo, or we write this or this. I always like have that metaphor, like stepping out, like step back from the pitch deck, look at zoom out of your presentation software. Hopefully that is Slidebean, but zoom out for a sec, look at the 15 or 20 slides as a group and ask yourself, like, am I answering these 4 questions? Because if you're not, then it's easier to see it that way, right? Easier to see it from that bird's eye view. Okay. But we can also transfer these questions into something. We can transfer these questions into sections of a deck. And to me, these are the colorful ones. Those are the 4 core sections of a pitch deck. The status quo, which has the problem, the business opportunity slides, the solution slide, which the solution section, which covers the product and how it works and who is it for. The market, which covers traction and how you're going to capture this market. And the why us, which covers you versus competitors, your team, and so on. So, that translates to structure. But let's dig a little deeper. By the way, this diagram, this is probably the best slide today. So if you want to screenshot a slide, this is the slide to steal. But if you don't want to have to convert that to a deck, you can just use our template. There's a template at Slidebean. Every template that we have for startups for pitch decks follows this exact format. So you can just hit slidebean.com. It's free to sign up. You can grab any of our templates. They all follow this structure. So you won't get lost. Paul, to your question, no, I don't share my slides, man. Just no, but you can watch the webinar on like the recording. Okay. Or maybe you don't want to use Slidebean, and I'll forgive you for that. But if you don't want to use Slidebean, you can still use our pitch deck reviewer. So we have a pitch deck reviewer where you can upload any deck in PDF format, and we'll run it through Megatron. That's our AI, and we'll give you a rating. We'll rate every slide. We'll tell you what's missing. We'll tell you what's working, what's not. Last time I checked, we had reviewed about 2,500 decks, like 36,000 slides. And they were all kind of following the same patterns of issues, right? Traction was always an issue. TAM was always an issue. I'm going to talk about that. And damn, I can't remember. Oh, and overcrowded slides. Those are the top 3 issues that over 2,500 decks Megatron has been able to detect. So it's not called, it's just internally called Megatron. I'm sorry. It's not that evil. Okay, so let's talk about the slides. All right, so we talked about the intro section, not a lot there. Intro is usually a cover slide. Sometimes I like to include a traction teaser slide in the intro. If your deck is, I don't know, 20 slides and you're scared that your investor might be bored by slide 10, which does happen, you can throw a slide 2 as what I call a traction teaser. So traction teaser is, hey, like our product is growing. It's like a summarized traction slide where you say, hey, we have 20K in monthly recurring revenue, and we've been growing 10% every month for the last 6 months. And when you look at that, it's like, holy shit, what is this company? I want to dig deeper. Now, obviously, this traction needs to be good. If you don't have a lot of traction, then don't do a traction teaser slide. I don't think beta users are a good traction teaser. I think signups are just vanity metrics. It has to be revenue. It has to be customers. If you don't have it, then just move along. Okay. So status quo section, right? Let's remember the question that we're trying to answer here in the status quo, which is what opportunity have we discovered in the market? Normally, I like to do that through 1 or 2 slides, which is this problem or opportunity, right? Which is what problem have you identified in the market? What have you discovered that other companies haven't? Sometimes you have to do a market overview. I didn't include it here, but it's like, well, this is the market just so we can get on the same page, right? And obviously, again, keep them short, keep them clear, use 3 or 4 sentences to keep that crystal clear. And the solution, even though that's part of the next section, remember that, as you pose this problem, your solution slide needs to be sort of like the answer to that question, right? You're saying, hey, here's the problem, and here's how we're going to solve it, at least in the abstract. So some good examples. This is the deck that I'm using today. This is 11 Labs pitch deck. This raised them their first $2 million round, if I'm not mistaken, and that's from 2022. By all measure, an AI company, right? So they tackled the status quo section with 2 slides, which is this one. I would call this, it doesn't have a title, doesn't say market overview, but it is a market overview, right? Which is, hey, like here's a market. People want to listen and watch content in their native language. Dubbing is the way you would normally do that. It's very expensive, about $100 a minute, and it takes a long time. But that's the only way it's done. If you're an outsider, right? If you don't work in video production, or film or YouTube, I guess, then you have no clue what dubbing costs like or why it's important. Like you would have no clue, right? The investor would have no clue. There's a good chance that they won't. So that's why, and remember, these guys are an AI company, so they're pitching AI investors, right? So they have to kind of give that context of, hey, this is what's happening, or this is the way the world works in this market of content creation, right? But that's not the problem. This is just context, right? So this is a very proper market overview slide, which bridges into the problem. And I love this problem slide. probably one of my favorites ever because it's just one fucking sentence, man. That's it. That's it. There are no affordable tools to make content watchable in any language with high quality. That's it. Like I think that great problem slides are short. Great problem slides are like concise and to the point. There's no jargon with this. There's no exaggeration, no nothing. It's just like this is the problem. Here is very simple. Content watchable in any language with high quality. I mean, sorry, no affordable tools, which I would have highlighted too, but that's it. That's the problem. I normally don't recommend doing problem slides that have more than 3 bullets. If you need more than 3 bullets, then your problem is maybe not that powerful, right? In the end, what you want to do here is pitch a problem that's very a pain point that's very strong, right? It's like this is, oh man, like people that do this for a living, they really struggle with this thing. And that's a solid problem slide, and that's why it is. Okay. So that segues into the product or the solution section, right? So what have you built to tackle this? How does it work and who is it for? That comes with the solution slide, comes with the product slide, with features, audience, use cases. The business model, I think, is part of this section too, and milestones and roadmap, kind of like the vision for what the product is today or what you've accomplished with the product and where it's going. I think all of that is the product section. Honestly, this is the section where founders struggle the least. Founders are usually really good at this. They know their product. They love talking about it. They have screenshots, hopefully, and mockups. And now you can make mockups with anything, right? So, I mean, a deck without mockups in this day and age is unacceptable, I would say. Because you can use Figma Make and do it in seconds, right? So, solution, product, benefits, audience, business model, milestones. I'm gonna give you a few examples of this. This is a solution slide, right? Like I said, the solution slide is sort of like a mirror to the problem, right? So let's remember that problem slide. It's one sentence, but we're talking about 3 issues: affordability, watchable in any language, high quality, right? And this slide sort of answers those exactly, right? Human quality, personalized, simple, and quick. I don't think it talks about cheap, but I think it's kind of implied with the automatic dubbing in the title. Right. So the solution it's a very abstract slide. Notice that we're not showing the product yet. We're not showing how it looks. We're not talking about the underlying tech. It's just simple. We've posed this problem and we have this proposal for what the solution is. Tell me more is, I think, the expectation that the reader should have. Yeah, and so now we're talking a little bit about features, right? I would call this a feature slides. They call it a prototype deep dive. But the idea is, yeah, it takes one language, turns it into another. It has a demo video. I think that I'm not a big fan of demo videos. A lot of these decks get distributed in PDF form, or investors are not necessarily sitting at their desk the first time they see the deck. So if your pitch deck value depends on the video, then I think that you're in a little bit of trouble, I think, because there's a chance that people won't watch it. We've run some numbers on this, and the average investor will spend 4 minutes looking at a deck. And so, if 4 minutes, if their investment, like the time they're willing to spend like dealing with this founder that just pitched them is 5 minutes, are they willing to take 2 of those minutes to watch this demo? I think probably not. I'm not a fan of videos, but sometimes it's the only way. Here, if you're pitching 11 labs and you're kind of bragging about your speech quality, I mean, is there another way other than a video? I think not. I think it's hard. Maybe link to a YouTube video. That way it's not embedded in the presentation. Again, knowing that this is going to be maybe distributed as a PDF copy or whatever. But yeah, this is more like a features. I mean, it looks a little bit features or how does it work, right? That's another slide that I think I mentioned. I didn't, but that's another valid slide in this section. How does it work, right? Like you upload a movie, you get subtitles, you get translation, blah, blah, blah. That's good. I think, yeah, sorry, like this is more like a how does it work? This is more like a product vision or product feature slides, right? And then, yeah, I think there's some really interesting stuff here, right? Where, it's very clear to them how their journey begins, right? Their first journey is Twitch, YouTube, Final Cut. I mean, I think amateur creators, right? I don't know if I'm pro creators or creators, right? People who don't have the budget to spend $100 a minute to dub automatically, to dub with humans. So how do you do? How do you do it? Well, they dub with this automatic feature, and their expectation is that 11 Labs will go on to become the dubbing tool for everything, right? Zoom logo in there. We'll see. I don't know. We'll see. But this is a very interesting vision of what they think their product might become. But what I love, probably the best slide in this section is this one. Our start content creators. This shows that they have an audience that they understand. This shows that they have an audience that needs their product desperately, right? So they mentioned Mr. Beast. And it's a great validation too, right? So you have 100 million back then, 100 million subscribers on Mr. Beast English and 20 million in Mr. Beast Spanish, right? The best proof that you have that 20% of the audience wants to watch these videos in Spanish. Yeah, so like that's a core sample of like who uses this product, right? They don't have to say, oh, our typical customer would be a YouTuber with a certain number of subscribers. No, they've actually given you an example, and they've used the slide for that, for double purpose, right? It's a purpose of this is my audience, but also a purpose of this is why this product is needed, sort of like a market validation thing. Next section is, well, how much are you growing and how much are you going to continue to grow? Normally, the slides in this section are traction, go-to-market, and market size. Their 11 Labs, the 11 Labs traction slide was redacted I mean, they didn't share that. That's fine. But they did share their TAM slide, which I think is a great slide, which talks about this, right? It's like, notice that the market, they're not talking about the market of dubbing, right? A typical founder, we're going to say, oh, the dubbing market is $300 billion, and we're going to take 1% of that. No. They've kind of given us the circle thing where, where we have there are 100,000 YouTube creators that have over 500,000 subscribers, which means that they have enough money to pay for this thing. And that's what they call their obtainable market. Their TAM, look at their total available market TAM is all creators. I don't think that's correctly their TAM. Their TAM is probably the 2 million, the professional creators, because the others I wouldn't use this product or wouldn't pay for it at least. And they're saying, well, how much are they dubbing? They're dubbing about 9 minutes a month, which is actually small, actually very conservative, which translates to them into $100 million a year, $110 million a year. That's a fantastic TAM slide. It basically tells you how much money can this company make if we're able to become what we are setting out to become. Last section, why are you and your team the team to change the status quo? Normally, this section includes competitors, competitive advantages, and team. These two axis charts, I love it. It's the chart that Steve Jobs used, and when he presented the iPhone, and Steve Jobs made it so obvious. And the reason why that worked for Steve Jobs, and I think it works here too, is because it's very clear, what each axis is. One is quality, the other one is speed. I want to call it speed. What I see sometimes is like founders come up with like 4 different axes, and they put them across charts. So they kind of, as long as you do it with 2 different variables, and you are in the top right corner, which is where you should be, and you're alone in that space, then this chart is worth it. Otherwise, you can approach something more traditional with just talking about competitive advantages. The way I love to think about competitive advantages is, what do you understand about the market that others don't? What do you know about this problem that your competitors haven't figured out? Or why is your product better and it's still not something that the competitors can easily copy or steal or snatch, because you have this understanding that the others don't. Sorry, duplicate slide. Sorry, my bad. The other one was my bad. The other one was the team slide. On the team slide, you probably want to do, let's go back to here. On the team slide, you probably want to do founders. I would rather not do advisors. And last note on founders is that these founders need to have the capacity, the skills to get the company to its first, say, 100K in revenue, right? So if you have a team of founders but you're missing your engineer, then that's not a full team. If you have a team of founders but you don't have somebody who's going to run your marketing, then you don't have a full team. Remember that at the early stage, you're not going to have a lot of money to recruit experts on any of these things, right? You might recruit some junior people. So you have to own that alternative. All right. Last section is the ask. That's normally financial projections, fundraising. how much money you're going to need. We are running out of time, and I want to make sure I get to some questions. So the answer to that is we have a bunch of tools, man. We have a bunch of tools that can help you do that. On Slidebean, you get an AI, obviously our AI pitch deck builder. You get an investor finder, over 20,000 investors in there. You have our cap table tool to estimate how much equity you're going to need to shed through these rounds. We have a financial model and a financial modeling bootcamp that teach you how to run these forecasts and how to run these projections. And if you, in some of our plans, even include one-on-one time with my team. Slidebean Accelerate, which is our most popular plan, includes a monthly one-on-one with our pitch deck team to go over your pitch deck, a monthly one-on-one with our financials team to help you navigate the financial model and teach you how to use it, and includes 2 strategy calls with me. We normally do 1 group call as soon as you sign up, so we can get the ball rolling, and then after you've gone through a few revisions on the pitch deck and the financials, we do another one-on-one call sorry, lost my train of thought. I saw a question and I was answering in my head. Another like final call, if you will, to kind of get into more strategy about how you're going to approach the round, valuation, and other more advanced questions that founders often have. All right, that is, you want to snatch that. My team's going to paste the link to Accelerate in both chats, and then I'll stop my slides. I'll check my calendar because I do have a hard stop, but I can go through some questions if you have any. Let's see from Lavina. This is incredibly helpful. I'm glad it was awesome. Thanks, John. Why no advisors? Man, I think the reason I don't like advisors on the team slide is because most of the time advisors are not going to have a crucial impact in your company. If you're enterprise, then yes, because intros I think go a long way in enterprise or like B2B, large B2B. But beyond that, what you get from your advisor is 1 hour a month, maybe 1 or 2 hours a month, in time, and that doesn't change the direction of a business, right? Unless it's a really big name that the investors are going to know who they are. If you have to explain who the advisor is, then because the investor doesn't know it, then I'd rather spend that time explaining why you're a better founder than trying to sell the advisor. That's just how I feel. Yeah, company in a regulated industry like healthcare, great exception, right? Maybe you need someone who can help you navigate that. But again, if you need, and that's kind of like a team versus advisor question, right? If you need somebody that has a really deep understanding of regulation in order for your company to succeed, right? In healthcare, is that person an advisor, or should that person be a co-founder, right? That's don't forget that question. The SaaS moat used to be the software was difficult and expensive to build. That is no longer the case. Great point, Ryan. What do you foresee as the key moats VCs will be looking for? Network infrastructure, users, IP, nuanced data sets. Man, such a great question. Such a great question. The best I can give you now is traction. Like most of the companies I work with are pre-seed and seed. Traction is the one thing, right? At pre-seed or seed, you probably don't. You probably don't have a lot of strong infrastructure. You have users, i.e., traction. IP, probably not that much at that early stage. Speed and traction for sure. Nuanced data sets, you're probably not going to have that much data either, right? I think network goes a long way always. I always, founders, if that's the reason why solo teams are hard to fund too, right? If you're a solo founder, like really, like you couldn't find anybody to join you in this company. Is that because you're maybe hard to work with, or because you don't have enough of a network, right? And that becomes a problem. That becomes, I think, a bit of a flag for investors with solo founders. Not a red flag, not a complete deal breaker, but a flag. I think the other example is going to strangers, having to go to investors that you don't know for your pre-seed, which means that you don't even have like a small network of people that might invest in your pre-seed. I didn't. I'm including myself there, but I'm saying it's a bit of a flag, right? So when I started my first company, I didn't know anybody, so that's a flag. That means that if you're struggling to find your first set, how are you going to find your first, I don't know, 500K worth of cash of checks? How are you going to find your next $5 million check if you don't know anybody, right? So network is really important too. I think it it was before, and it'll ever be for founders. Um, Well, bunch of questions. Okay, okay. What do you do when the big guys may build competing products after studying your usage of their infrastructure? That's going to be a problem for any company at any time. Any company suffers that. How do you battle it? With traction, and you battle it with this with the competition slide where we talked about there. What do you understand about them that they don't? What allows you to move faster or to iterate the product quicker? Or how do you establish this user base, that core user base that loves your product, that is not going to cancel because this other company now does the same thing? Um, how does it become a flag if you're acting as a solopreneur initially? Again, an extra problem with solopreneurs is that you have to do so many things at once, right? If you're by yourself, are you coding and marketing and going to investors and running operations and dealing with customers? Well, are you doing all these things, right? Customer support is easy. You probably use some AI at this point, but operations and talking to investors, investor relations and marketing or sales and product, like all these things, like how do you divide a day, like 2 hours for each? It's hard, right? That's why I think best companies are built by small teams at the beginning. There's this whole conversation on whether your co-founder could be an AI, but that's for another day. Maybe last one, McKinney Corner. Do you work with African startups? Are you more focused on Western solutions with Slidebean? Do you think there are different nuances with Slidebean works with African startups? I think a pitch deck is a good pitch deck anywhere in the world. Um, on solo founders, it's a mixed signal on gurus saying that with AI you can build a one-person company. Oh, there you go. Yeah, I don't think we're there yet. I think we're maybe going in that direction, but I don't think we are there yet. I think that you still need a team of people. Thankfully, thankfully. Alrighty, guys, I have to run, but hope this session was useful. Remember, we have sessions every week now. So next week, hope I'll see some of you on that one. Thanks for tuning in. Good luck with your fundraise and your pitches. Use Slidebean.